hit it.
It's Friday, March 10th, 2023, episode 208. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome back Dario Perkins from TS Lombard. Dario updates us on his macro views, explains why this is a fake cycle, and most importantly, quantifies the moron risk premium. Then we have a short show, so it's only Patrick reading his cave drawings and talking charts.
We'll be back to our normal format next week, so stick around. We got a great shorter show. Kev, we got to give a disclaimer out here, buddy.
Right. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include the swollen testicles, the inflation gestations, and the fin-twit front-load fungus. That one's bad.
Yeah. No, I wouldn't want that one. All right. Let's get to the interview.
It's our great pleasure to welcome back to the show Dario Perkins from TS Lombard. He's got some fancy title, Managing Director, Global Macro.
Yeah, I think that's about right. That's what they want me to call myself.
Dario, it's great to have you back on the show. You've already got Lena and Stitches laughing about a million different things, and we're going to have a lot of fun at the end. But before we get to that, let's talk a little bit about markets. And one of the things, you were kind enough to send me your pieces, and I'm going to quote something here just to kind of jump in. Because one of the things that I think that you're very unique in terms of strategists is that you believe that this cycle is much different than previous cycles. And I'm just going to read you something from your recent report. This was no ordinary business cycle. Instead, it was a global economy distorted by the combination of a one-off government stimulus, pent-up demand, massive supply disruptions, and eventually the war in Ukraine. Central banks, of course, will claim that it was their vigorous response that has delivered this outcome. They cut off an inflationary boom before it could really get going. But transitory or not, the shape of the COVID recovery is now becoming clear. It was neither a U, nor a V, nor an L, not even a K. It was an A. The whole global economy, along with most asset classes, is tracing the same pattern as Cathie Wood's ARK investment fund. Could you just expand on that? I think it's as I say, I think it's unique and I think it's insightful.
I mean, with me, it's almost become a sort of cliche, this thing about the business cycle, because for 3 years, I've had clients asking, where are we in the cycle? And my answer is always the same. So you think they'd stop asking, but this isn't a business cycle. You can't use a Phillips curve or sort of traditional investment rules to sort of work out where you are in a cycle, because a cycle is sort of natural and endogenous. And this has just been one big kind of head fuck, basically. Think about it. I mean, we shut down the economy. We piled huge amounts of stimulus into an economy that was sort of half open. We then tried to open as quickly as we could. We had all sorts of supply side issues. We had all sorts of new variants of the illness. We had these sort of stop-start lockdowns in Europe and then in Asia. And it's just been one enormous mess. And so I don't know how you're supposed to sort of look at that from a sort of Phillips curve framework and say, well, now we're in late cycle or now we're in early cycle. It just hasn't worked. And so I think the best you can really do is look at history. And it's difficult because we've never had a sort of historical episode that is quite like this. But there's one that comes pretty close. And that also traced this sort of A-shaped sort of boom-bust cycle, which is the Second World War. And actually, when you look at the nature of the inflation that we've experienced over the last 2 years, it sort of has the same source because, we came out of the Second World War. We had massive pent-up demand. We had household saving rates that had hit sort of 25% in the US and the UK. And then we unleashed this demand into an economy where there were massive supply side problems. It was sort of very clear and physical after the Second World War because you basically destroyed shipping routes and you had these huge increases in commodity prices as we tried to sort of rebuild after the destruction of the war. But you had this huge increase in prices. And, in the US after World War II, you basically add 20% to the price level. You add 40% to the UK price level. But ultimately, it doesn't turn into this wage price spiral and inflation settles down by itself. And so I think that was always what was going to happen with this. I always thought there was this big transitory element in inflation. But I think, if anything, central banks have actually compounded the volatility that we're seeing in the economy, because they just sort of freaked out. This time last year, they start to panic that, oh my God, the 1970s is happening again. And if you're a central banker, we spent the last 40 years taking the piss out of Arthur Burns and the guys at the Bank of England. It's true. These guys are a sort of textbook case study in failure, in monetary failure. And today's central bankers, they were looking at this thinking, oh my God, in 40 years' time, are they still going to be talking about these areas where we didn't respond to the inflation? So they've been raising interest rates, very, very quickly, trying to catch up. And that's just sort of compounded the volatility in the economy. So now we've got, all these different sort of cross currents and noise and distortions that are just getting worse, and sort of overlaying that with a sort of monetary induced housing recession in a whole bunch of economies. And it's just very, very messy. And it doesn't fit a normal business cycle. The best I think you can do is look at those sort of historical parallels and try to figure out where we go from there.
One of the lines that I love that you came up with was premature extrapolation. And I was wondering, are you referring to central banks, market participants? Who's doing that, and what are the consequences of that?
I think there has been a sort of tendency to over-extrapolate. So you go back to March, well, you go back earlier. So go back to February 2020. Oh my God, this is just like the global financial crisis. You're seeing sort of freezing up of markets and asset prices falling. And then we get this big rise in unemployment, and suddenly everybody's talking about this is the 1930s. These are the levels of unemployment that we last saw during the Great Depression. And then, even then the economy starts to recover, but at first it's sort of incomplete and imbalanced. So everyone starts talking about, well, this is going to be the K-shaped recovery. Remember the K-shaped recovery?
Right. Why don't you explain to people what the difference is?
So the K-shaped recovery was the idea that some parts of the economy were recovering, stuff that you could buy online, for example, and some parts of the economy would never recover because, we were never going to go out again and we were never going to go to restaurants again, and all of that sort of wild extrapolation that was going on. And then, towards the end of 2020, you've got the IMF talking about the world is in a global liquidity trap. Do you remember that? There's a big op-ed in the FT where they're saying governments need to spend a lot more on fiscal policy. Now, if that wasn't a marker for a serious inflation outbreak, then I don't know what was. Then you had inflation start to take off, and at first, every investor wants to talk about this, but nobody believes it's genuine. I remember when inflation first started to break out, I had maybe 25, 30 client meetings in a row, all about inflation, everyone obsessed with inflation, but nobody was actually worried about inflation. It was this bizarre sort of risk management that was going on among.
It's like teenagers with sex. They find that everyone talks about it and assumes everyone else is doing it, but in reality, nobody's doing anything about it.
Exactly. And then inflation, really did start to break out, and we were looking at the highest levels since the 1970s. And then people start to think, well, there are some sort of eerie similarities with the 1970s here. The commodity prices, the worries about second round effects, the energy price shocks. And then suddenly you have people sort of extrapolating this sort of stagflationary environment, worrying about the 1970s, central bankers losing their shit and raising interest rates as quickly as they could. And now we're on the other side of this, I think, where we're starting to worry about a slowdown and a recession, which is still largely artificial. And this is the way that we've constructed these leading indicators. So, we spent sort of 30 years building leading indicators of the economy. They're all based on manufacturing. Now, there was no way global manufacturing couldn't experience a recession on the back end of, what's been happening. We're in a situation where we're all at home buying stuff off the internet, causing huge increases in global goods demand, huge increases in world trade, huge increases in manufacturing. And so as we rotated back to a normal economy, we were always going to get this sort of recession in manufacturing, big declines in global trade, and big declines in leading indicators. And the thing about all of this is that when you look at long-term inflation narratives, they've basically tracked sort of commodity prices and global goods prices. The whole sort of long-term bond market narrative, where we're going, the sort of long-term probabilities that are priced into bonds are just a simple play on whatever happens to the global manufacturing PMI. It's sort of bizarre. So now, we've been in this period where people are just been worrying about worrying about recession. So everyone's panicking about recession, I think largely sort of artificially. And now, we've gone into this year and actually things haven't quite fallen apart in the way that people are expecting. So that sort of consensus recession forecast is what's happening is what always happens with these forecasts is they don't cancel them, they just postpone them.
Now you've seen a lot of cycles. Would you say that the willingness of the market to price in a recession has been unusual? In meaning that, like, they all priced in an aggressive Fed, but then 6 months out, they priced in the Fed having to cut rates because they figured the economy was so sensitive to rates. And the big surprise has been that the economy hasn't been as sensitive to rates as everyone thought, and that that imminent recession that was always 6 to 12 months out is just kind of continually being priced out. But in my mind, that's kind of been an unusual development. And I was wondering, do you think that is the case, and do you have any theories as to why it's happening?
I don't remember a time when there's been such a clear consensus that a recession is coming. I think even in sort of 2008, when we were already in recession, there were sort of active discussions about whether there would be one. There wasn't a sort of very clear consensus that there would be one or that it already happened. I think that, what's been really unusual for investors is they've never heard central bankers talk about a recession before it's happened. So that sort of freaked people. And I think for a while I had investors saying, well, what does it mean? When these central bankers are saying we're going to have a recession next year, what does that actually mean? Because usually, central bankers are sort of cheerleaders for the economy. Is it that that's what they want to engineer? So is it that they're just going to keep raising interest rates until they generate that recession? Or is something changed? And I think part of it is that it isn't true that central bankers never forecast recessions, because I went back and I looked at all the Fed sort of archives just before every recession. And actually, the Fed had a really good track record of forecasting recessions. Now, if you define a recession as a rise in unemployment, the Fed actually did better than the bond market. The famous sort of yield inversion, that famous yield inversion, which is your best indicator of a recession. Actually, you look at Fed forecasts for increases in unemployment, they spotted every recession. What they failed to get was the severity of the recession. So, they went into every recession expecting a mild recession, and it always turned out to be much worse. And I think part of that is the sort of natural reflexivity of a recession, because I think you have to define a recession by it's basically a process. That debate people were having last year about whether 2 quarters of negative GDP growth in the US counted as a recession just sort of missed the whole point, because a recession is a process. What happens is companies start to fire workers. Those workers then, stop spending, or they lose confidence, and that spreads to other workers, and you get a decline in spending in aggregate. Then that feeds back into revenues, and then you get more rounds of job losses. That is the recessionary process. And that's not what we saw last year. That's not what we're seeing now. That's not what we saw in today's payroll report. I think there's still quite a lot of resilience in this economy. And I think you're right that, we haven't seen the sensitivity to interest rates. And I think part of that is that, people are used to thinking about interest rates in a very low inflation environment. And it's not that you need to look at real interest rates. I think it's more complicated than that. It's the fact that if incomes are rising very quickly in nominal terms, if wages are rising rapidly, if nominal profits are rising rapidly, then you can't just look at the change in interest rates. You also need to take into account that, what's happening with incomes. Because over time, there's an immediate squeeze on the economy that comes from interest rates rising suddenly very quickly. But over time, you can actually grow into higher interest rates. And so I think that's sort of what people have been missing. in this debate about, why aren't we seeing an effect?
The other kind of interesting kind of anomaly in terms of this cycle has been the difference
Not a
between
cycle, Kevin.
Oh, that's right. I'm sorry. You got me, Terry. You got me. Has been the difference in the hard and soft data, meaning hard, the actual economy, like the real kind of counting how many widgets are created, and then the soft one, which is in essence kind of people's surveys about future expectations and businesses' plans. I was wondering how that kind of fits into your whole narrative about it not being a cycle, or in terms of this cycle being different, or I guess, what are we going to call it if it's not a cycle, Dario?
Yeah, that's what I struggle with, actually. What are we going to call it? Okay, you can call it
You can't just shit all over something and not come up with an alternative.
If you use inverted commas, I'll just assume that you're using inverted commas around the word cycle. And then
Okay.
Feel free,
Okay.
So I think I think part of it is that things generally feel a bit shit. The inflation has been very, very high, and it's in very noticeable things. So, when you go grocery shopping, you notice that prices are going up very rapidly for food and for energy and all of those things. So it doesn't feel good. I think part of it is that, a lot of this sort of soft data and leading indicators are weighted towards industry and manufacturing. And I think that stuff is really struggling. I think that when you think in broader terms about sort of broader consumer spending, then you're seeing a lot of resilience. And I think part of the problem that we've had over the past sort of 12 months is that inflation has been growing much stronger than wages. So it's really been eating into people's real spending power. So you're spending the same amount, or you're spending more, but you're getting less stuff for your money. And I think that just pisses people off. But you've still got that sort of resilience in overall spending that is still keeping the economy going.
One of the things that you were you believed strongly in is that the 1980s inflation was actually not a function of being broken by Volcker, but was instead broken by Thatcher and Reagan. I was wondering if you could kind of review that theory, and then also kind of bring it into today's environment and tell us how that might apply for inflation right now as we speak.
So this is my super cycle thesis.
Okay.
So I might say what I've done is that I've sort of studied these very long cycles in inflation and interest rates. And we're talking about sort of 30, 40, 50-year cycles. And I think ultimately what that comes down to is the balance of power in the economy. It's about the balance of power between labor and capital. And so if you look back, right through history, and you basically date the capitalist system from sort of 1870, then you've had three super cycles. You had one super cycle, which was in the sort of second half of the 1800s, which was completely dominant. It was the complete dominance of capital. So you had a rapid globalization, you had rapid technological change because of the Industrial Revolution, and workers just got absolutely hammered, and corporates just had a party. And the wage share went down, the profit share went up, asset prices went up. And that was fine for a while. It resulted in very low inflation, negative inflation, deflation. That was fine for a while. But towards the sort of 1890s, you start to get a political reaction to that. So you get the first sort of anti-globalization, the first protectionism, you get the first use of the word populism. And then you have the two world wars, and then you come out of the Second World War and you've just got a completely different economy. And this is what they call the mixed economy. So it had a much bigger role for government, had a much bigger role for trade unions. It just tilted that balance of power all the way back to labor and away from capital. And then, that sort of worked for 20, 30 years. But towards the sort of 1970s, the labor power has gone too far. You've got the powerful trade unions, you've got this big slowdown in productivity, you get the wage price spirals. And then we have 15 years of stagflation. and then the politics shifts again, and you have a reaction to that. So suddenly there is this willingness to just destroy labor power. So you destroy the trade unions, you open up product markets, you open up capital markets, you allow immigration, and then you have this long 40-year super cycle of capital's dominance, labor getting absolutely clobbered. And you sort of, by the irony is that you sort of end up where you were in the late 1800s, because now you've got inequality, disinflation. We masked a lot of this for a while with the sort of debt bubble, the subprime debt bubble, which was basically a way to sort of disguise inequality. So the problem that capital has when it's in charge is it always leads to inequality, and the problem that labor has is it always leads to stagflation. So you have this financial crisis,
Yeah.
and then you have this sort of last throw of neoliberalism, which is this mindless austerity. So you have governments everywhere tightening their fiscal position, and you have central bankers trying to offset that with QE and low interest rates, and that was never going to work. So we end up with this long period of stagflation that was a bit like that sort of long depression we had in the late 1800s. And then, sort of 2019, before 2019, you start to get the political reaction again. So again, populism comes back, protectionism comes back, Trump in the US, Brexit in the UK, anti-European sentiment. And then we have the pandemic and Ukraine war. And I think that sort of super cycle is turning again. And we're starting to tilt that balance of power back towards Labour. But obviously, we're a long way from the 1970s. We're not going to get straight into the 1970s. We're not going to get those wage price spirals. But I think there is a very subtle secular change that's happening in the global economy because that balance of power is changing again.
And do you think COVID accelerated that change, or it was we were destined to head that way anyways?
I think we were always going to head that way. Before COVID, I was writing a lot of stuff about the sort of comparisons with the long depression of the sort of late 1800s. You could see that politics was changing. You could see that monetary policy had run out of ideas. You could see that even central bankers were sort of pleading with governments to spend more. You could see that that sort of inequality was no longer politically sustainable. And so I think you were beginning to see that political reaction. And then, of course, COVID comes along and we see that shift in the policy just sort of on steroids. So you have this massive fiscal response. You have central bankers just sort of financing that fiscal response. And I think you can see now that the politics has changed because we have an energy crisis in Europe. What's the first thing we do? We just subsidize everybody's income, and
Right.
because the politics is so difficult, and because it's so fractured, we can't even decide who the right people are to target with this stimulus. So you think about the energy crisis in Europe. It would have been really sensible to target that on small businesses, people on low incomes. But we can't, because if there's going to be a bailout, everybody has to have a bailout. Last time it was the bankers. This time we all deserve one. So we just throw 5% of GDP straight at the economy. So I think, I think that appetite for policy has changed. I think the policy mix, when we had sort of long-term UK interest rates at 800-year lows, I think that just screamed that the policy mix was all wrong. That mix of tight fiscal and easy monetary policy was deeply disinflationary. I think that policy mix has gone now. Clearly it has gone because we've got governments that can't stop spending and central banks that are raising interest rates. But it's more than that, because if you think about what that last super cycle was, it was all about neoliberalism. It was all about, minimalist government intervention. It was all about free markets. It was all about, destroying labor power. And I just think all of that is going into reverse. We've got governments that want to play a more active role in our lives. You can argue about the politics of this, but I think it's true that that's what they want. That's what's happening. You have governments that will need to intervene more because they're worried about climate change, because they're spending more on defense because of the geopolitical shifts. We've got this race for sort of strategic resources, and we've got industrial policy coming back for the first time in many decades. The basic sort of rules of neoliberalism are going. And we see this in protectionism. I think we see it in this push towards deglobalization. If you think that sort of deglobalization played such a big role in crushing inflation, getting the profit share up, getting the wage share down, then all of that starts to go into retreat. And I think the other thing about the thing that really killed labor power in the 2010s was that we had this sort of lukewarm economy, this disinflationary economy. And so we had this, a world where, because there was always this sort of surplus of labor, workers just had no bargaining power at all. And I think what we're doing now is we're seeing a higher pressure economy. We're pushing the economy harder. And I think that, pressure that's coming through in wages is going to mean a very different type of environment. And I don't think it's bad. People look at this stuff and they think this is all sort of inherently bearish and pessimistic, but it isn't, because it isn't that this sort of new economy is going to be really messed up. It's that the old one was really messed up.
Oh, I couldn't agree with you more, Dario. And you're the only person I've ever heard that's I've actually pushed back on the fact that rates so low show that there wasn't enough spending. And because I used to use that example, I always used to say to them, if you had a situation where the government came out and spent, whatever percentage of GDP and inflation started roaring, you would look at the bond market and you would say, look, the bond market is revolting. You guys are spending too much. And I said, why is it that when it goes the other way, when it goes from 3 down to 1 or to 50 basis points for a 10-year, why are you not looking at it and saying you're not spending enough? And I always thought that was a really interesting kind of paradox, that people would be willing to take the bond market signals one way, but not the other way.
Yeah, and I just think that whole environment was quite toxic. It was a sort of breeding ground for inequality. Median incomes and wages didn't go anywhere. But it was worse than that, because, we spent the 2010s sort of arguing about productivity. Why was productivity so low? But, when you look at what was happening with productivity, you basically had this big slowdown in technological diffusion. So there were companies, the superstar companies, that were spending huge amounts of money, investing in the latest technologies. But most companies didn't need to do that, because they could just rely on sort of cheap wages and cheap debt, low interest rates. And so you just weren't pushing the economy hard enough. And I think what you see with productivity, particularly sort of total factor productivity, is that it's very sensitive to how much you're pushing the economy. And so if we're moving into a world where these supply constraints are more pressing, where there is sort of persistent labor shortages, companies are going to have to invest more. We'll be pushing the economy harder. And I think we will end up with higher growth and higher productivity growth than we had before. And I just think people look at this and they're taking a very pessimistic view, maybe because of the politics of it. I'm not sure. But I think you have to take a very myopic view if you think that old world was ultimately good for financial markets, because in the end, it couldn't be. You couldn't have financial markets so detached from the real economy and expect there not to be eventually some backlash to that.
Right. You're absolutely correct. Wall Street was winning too much at the expense of Main Street. One of the things that I would love to hear how you deal with the pushback in terms of, I'm assuming you tell people this theory and they say, no, you're wrong. The politics aren't changing as much as you think. Just look at this inflation. People realize how bad inflation is. We're going to go back to not spending as much. This was a one-off because of COVID. What sort of kind of comeback would you say to somebody that's worried that we're going to slip back into the old environment of let's just say austerity and trying to get rates lower?
Well, I mean, I don't think we can. I think that, we're not talking about government spending on the same level that they did during COVID. I mean, those were sort of World War II levels of deficit. I mean, we're not doing that. But I think when you look at the next 5-10 years, you've got massive demands on defense spending. You've got massive demands because of climate change and, sort of transition to green technologies. You've got governments that want to sort of secure these strategic resources like semiconductors and all of that stuff. So they need to sort of build back domestic manufacturing. You've got reshoring. I just think you've got massive demands on governments. And another way to think about the sort of super cycle since the Second World War is that it's been all about the baby boomers. You can sort of exaggerate this story, but you think about it. The baby boomers, when they were young, they needed houses and they needed, sort of infrastructure. So you had these big levels of investment coming out of the Second World War. Then you get into the sort of 1960s, late 1960s, and they need jobs. So you've got governments that prioritize full employment instead of low inflation. And then, you get the sort of the 1970s is basically their midlife crisis. and then they, they sort of, they get into middle age and now their preferences change. They're no longer focused on full employment. They're now focused on saving. And so you get this sort of this big generation moving into middle age, saving more and more. That's pushing down interest rates. They want independent central banks. They want neoliberalism. They want all of that sort of politics that keeps inflation low because they want asset prices going up. But now we're getting to the situation where, those guys are retiring or have retired. And now actually they're demanding that governments spend more on healthcare. It's not, it's not even funny. In the UK, we went through this sort of ridiculous mini fiasco with the budget. And, still we have, a lot of pensioners and a lot of them are actually quite wealthy, but they've managed to secure, this sort of re-rating of their pensions in line with inflation, which is 10%. So all of these pensioners have suddenly got this big sort of 10% wage rise and they're all going out and spending. So, I think I don't see that sort of politics of austerity coming back. And I think you have to remember that the inflation of the last, year or so has been crap. But, this wasn't like the 1970s. By the time the politics had shifted towards neoliberalism, we'd had 15 years of stagflation, 15 years of wage price spirals, 15 years of sort of poor productivity and declining living standards. And that, that did switch the politics the other way. I just can't see that happening now.
We're just too early in it. Speaking of Britain,
also, I think the inflation probably evaporates quite quickly. The inflation that we have now.
Yeah.
So the way I think about this is that, as I said at the start, there's been a big sort of transitory element. We can still use that word, although we get cancelled if we do. There's been a big transitory element in inflation. And I think a lot of that comes off. I think people are much too deterministic in thinking about how this business cycle ends because they're assuming that because the economy is overheating, as evidenced by high inflation, then we have to have a recession. I don't really buy into that. I think that actually you could get inflation coming down quite quickly. But I think what's really changed, and this is the sort of basis of my super cycle idea, is that it's not that we're going to have sort of permanent 4, 5, 6, 7% inflation because, we're a long way from the, labor power being as strong as it was in the 70s. But I think what we're having is a change in the prevailing tendency of inflation. So, and I think I think I've heard you describe this on the podcast as 2%, that was previously a ceiling becomes a sort of floor. And I think that's right. And I think that's the way to think about it. But it's really profoundly important because it changes everything. Because, we were in a world where central banks did everything they could all the time to try and get inflation higher. And so we had permanently zero interest rates, QE, negative interest rates, all of that stuff. And we're now in a world where central banks will always be battling to get inflation down, but not the sort of 1970s inflation that requires them to raise interest rates to 20% and destroy the economy. But it is a world where they'll need to keep policy much tighter than it was in the past. And that battle is always going to be in the opposite direction. And I just think that's a profoundly important shift for financial markets because it changes everything. If you're an investor and you've worked in this industry for less than 15 years, I mean, that's basically the only world you've ever known, that perma zero interest rate world.
Right. Okay. So let's dive into that a little bit and let's talk about if you are correct about this secular change, how would investors appropriately alter their portfolios? Like, what should they be looking to do?
So I think it's a secular bear market in bonds. I don't think it's sort of straight line higher yields from here, because of these distortions, because of this fake cycle that we've been living through. You have this sort of pendulum between inflation and recession, and that's been sort of pivoting, very quickly. And at the moment, it's sort of pivoting towards recession risk and disinflation. But I think that, we're going to be in a world where we're facing sort of higher lows and higher highs in yields over time. And I think that a big part of this is that, the term premium in bonds, I don't understand why it's where it is.
You and me both, Dario.
I sort of do understand it, because I think it's the opposite of what we had in the 1980s. So if you look at the 1980s, you get this big decline in inflation, you get this collapse in inflation volatility, but the term premium stays really wide because people have been absolutely hosed on bonds for 15 years and nobody wants to get back into bonds. And I think what we've been seeing in markets over the last sort of 6 months is the opposite of that. At every opportunity, you have these sort of perma bond bulls. They're desperate to get back into bonds.
Yep. 100%.
And they don't see that the world has changed. And if you look at you sort of long-term inflation probabilities in bond markets, the bond market doesn't think the world has changed. But I think even if you don't buy my super cycle idea, which is that we're going to see a much more reflationary world than we had before, so we're going to have higher levels of inflation on average, I just can't imagine a world where inflation isn't a lot more volatile than it was before. And so, if you have a lot more inflation volatility, you have a lot more uncertainty about inflation. That should be part of the term premium story. The term premium should be widening to reflect that uncertainty. But it's worse than that, because the sorts of inflation volatility that we're talking about is probably going to come from the supply side. So we're going to be in a world where we get more frequent supply side shocks. And so if you have supply side shocks, you end up with periods of stagflation, periods like 2022. 2022 absolutely killed financial markets because it was stagflation, it was counter-cyclical inflation. And when you have counter-cyclical inflation, your bond equity correlation flips from negative to positive and everything goes down. And so if you're in a world where you don't have to be in the permanent sort of 1970s environment, but if you're in a world where you get more frequent years like 2022, because of climate change, because of deglobalization, because of whatever, you're going to get a weaker correlation between bonds and equities on average. And you're going to get periods where bonds just actually amplify the volatility of your portfolio like they did in 2022. And if that's the case, then your term premium should widen again. Because your term premium, if bonds, if you have the perfect negative correlation that we had before, then you sort of bonds become this sort of perfect insurance property for equities, and so you pay a premium to hold bonds, and that's what you have in a negative term premium. If you're in a world where bonds are losing that property or it becomes diluted, so they're not as perfect as they were before, then the term premium has to go up. So I think the implications for bonds are pretty clear. I think that if you lose that perfect hedging, I'm not saying that bonds won't be a hedge a lot of the time. I just think there'll be periods where they're not a hedge and where they actually have the wrong correlation. If that's the case, then you need to change your bond weight and you need to look for something else that can replace bonds in those sorts of environments. And the obvious thing is commodities, because I think the nature of the supply shocks that we're having over the next 5-10 years are going to be all about commodities and globalization. And with globalization, it doesn't really matter what we do. You can argue about the politics of this, and I mentioned it. I mentioned climate change. I mentioned climate change once on Twitter, and I was getting all these sort of tweets back telling me off for the political aspect of it. But the point is, with climate change, it doesn't matter what we do, because if we do nothing, we're going to get more extreme weather, more extreme supply side shocks that come from the changing climate. If we try to offset that and we're successful, then we're going to be transitioning into energy that is much more intermittent. We're going to be creating, massive pressures on commodity markets, and we'll get volatility inflation that comes from that, sort of greenflation. So whatever we do, I think we end up with more volatile inflation. And I think that means that bonds just get killed over a period. Real returns in bonds are just horrendous. The more nuanced story, I think, is what that means for equities.
Okay, don't go there because I don't want to go off bond for a quick second.
Sure.
I completely agree with all of what you said. I'm wondering about whether that realization about the term premium shouldn't actually be negative. It should be positive, and we should, back up 200 basis points in the tens. Do you worry that comes all of a sudden, and that we get maybe a UK style event like in world bond markets all around the globe?
I think that there is a risk of that. I think the UK was quite specific to what was happening in the financial sector. So we had this sort of we had parts of the pension fund industry that basically taken the view that interest rates were going to be zero forever, and they were doing things that were unsustainable in a rising interest rate environment. And then when you had this insane budget from the UK government, and the politics of it was just awful, you had this sort of amplification mechanism. Now, when I look at sort of potential amplification mechanisms right now, there are some things that worry me, like US banks. I think you could see some problems there in adjusting to higher interest rates, but I'm not sure it plays out in the same way. I think it's probably something that happens gradually over time, but it's I think it's very difficult. I mean, if you look at what happened in sort of the 80s onwards, it looks like it happened fairly gradually over time rather than a sudden event.
Yeah, so, it took years. Real rates were positive for a long, long time. They just ground lower forever and ever. Like there was 5 years where you could get 300-400 basis points of real rates versus tens versus inflation.
Yeah, I mean who the sort of perma bulls are in bonds on Twitter, and you know that every opportunity over the past 12 months they've been trying to get back in, expecting interest rates to go all the way back down. And maybe if this sort of central bank induced volatility in the economy gets worse, maybe we do have central banks cutting interest rates. But I don't think we're going back to zero. I don't think we're going back to QE. So I think over time, we'll realize that sort of underlying trend in interest rates has shifted. And, over time, I think that will get reflected in term premium. But it may not happen all of a sudden.
Do you think that you need the term premium to go up before they even think about YCC? And do you think that YCC is the inevitable endpoint for this?
I don't think that we're going to end up with the sort of really bad inflation dynamics that force central banks to sort of, to go down that route. I think what we're going to end up with is more periods of transitory inflation. So we'll have more periods like 2022 where inflation spikes higher,
right.
And you get sort of bonds and equity selling off at the same time, but you don't move to just sort of pegging interest rates down. What you have is you have central banks effectively telling lies, because central banks will sort of tolerate that higher level of inflation. So their inflation targets will move higher, but they'll never quite admit it. So, when you get those periods of high inflation, they'll still be hawkish, they'll still be raising interest rates, but, we'll look back and we see that they had a revealed preference for higher inflation. And, in being hawkish and in talking about transitory inflation, although they won't use that word for obvious reasons, then, they will try to pin yields down through that way by insisting. But, how many periods of transitory inflation do you need before people figure out that something has changed?
Okay, so now let's using that backdrop about what you think is going to happen in rates, let's talk about how you then make a plan for equities and what happens in that environment. So
this is my tangible 20s. I've been pushing this idea for sort of 18 months. And the only person that went with it is this wine company. I noticed that this company that was selling investment in wine was calling it the tangible 20s and urging people to buy vintage wines.
You're trying to start the meme going. Tangible 20s. Well, you know what? I think we got a name of the show.
And so, and so I think what this is about is that, we're in that world where financial markets and the real economy just got completely decoupled. And I think, Cuppy kind of touched on this when he was talking about the two-speed economy. You remember last week, the two-speed
Yes.
economy. So we had this complete detachment. We had an environment where the economy was lukewarm. It wasn't really growing. The policy mix was all wrong. Interest rates were at zero. And so as an investor in equities, what did you do? Well, you just bought long duration US tech. And so that just got continuously re-rated. And then you felt like a superstar, a genius, because you're investing in all the right stocks. But if you look at, the way that those companies tend to perform versus, the sort of growth versus value, the 2010s is a really bizarre world. You can get data on this back to the 1920s, that Farmer French database. There is no other period in history where you've had that massive outperformance of growth versus value. And I think it was a reflection of that lukewarm economy with zero interest rates and QE. I don't think it was it wasn't sort of direct QE injections. I know people like to plot balance sheets against central bank balance sheets against stock returns, which has never really been my thing. But I think that QE sort of cemented the idea that interest rates were going to stay low forever, or stay at zero forever. And I think that encouraged people into those long duration industries, those long duration stocks. And I think if we're in a world where that's gone, where central banks are always fighting to keep inflation down rather than get it higher, I almost said get it up, but that would have made Lena snigger. They can't get it up. I once said that in a client meeting and the salesman kicked me under the desk. I said, central banks just can't get it up. Never mind. So if we're in a world where the bias in policy has changed and, central banks are sort of battling inflation and the economy is growing more quickly and inflation is generally higher and reflationary, then I think you're in a different sort of stock market. And so, what you want to do is you want to buy value companies, but also you want to think about the sort of secular growth themes for this period. So if we're talking, decarbonomics, if we're talking sort of cold wars between, Russia and Europe and China and the US, if we're talking friendshoring, if we're talking, massive green investments, private and public, then, infrastructure rebuilding, one of the big sort of casualties of austerity was infrastructure. We've got infrastructure crumbling everywhere because we haven't invested. Europe's had no net investment in public infrastructure for 15 years, which is just bizarre. If you're in that sort of world, then the whole you just get this sort of secular rotation in stock markets. You get it within sectors, you get value outperforming growth, but you probably get a bit of it internationally as well, because one of the big things about the US outperforming for so long is that it just had this big tilt towards, long duration tech. And Europe and the emerging markets didn't have that. But if we're in a world where you're pushing the global economy harder, I think you start to see some of that money move back into those other markets.
All right.
So you want exposure to the real economy, which is why instead of intangibles, you want tangibles. Hence the tangible 20s.
The tangible 20s. We're going to get this trending on Twitter.
I've tried.
I know you're more of a big picture fellow, and you don't look at kind of microstructure. But I was wondering if you have any opinion about the rise of these 0-day options. Everyone's talking about them, and you think it's a brouhaha about nothing.
It's not really my area. I haven't done the work. I don't want to just bullshit something.
You're going to be a unique amongst our guests if you actually do that.
No, I haven't. I just haven't looked into it. I like to research things before I talk about them.
Okay, well, talking about that research, I actually, when my ears perked up when you said that there had never been a period when growth outperformed value for as long as the 2010s.
Or to the
And
degree. So the
to the
duration
degree,
and the
okay.
degree. Yeah. So I mean, I can send you charts on this, but if you get that Farmer French data and you look at the sort of ratio of growth to value and you plot it all the way back to the 20s, it's basically like a sort of hockey stick. So you have this long period of value constantly outperforming growth, and then you get to the global financial crisis and it flips. And it's, and that period is just incredibly unusual. You've had periods where it's happened for a while, like the .com in the late 90s, but you've never had a sort of decade like that.
And do you think that this is also now a situation maybe similar to the bond term premium where investors are slow to realize that? I know Steve Eisman from The Big Short fame has been on TV talking about how sometimes it takes, hitting investors over the head with a 2x4 to wake them up. And do you think that that's what's going on in terms of the, let's just say the speed upon which that's unwinding? Because it's gone probably slower than the value guys might have hoped.
Yeah, I think there's two parts to it. So one of them is that if you look at growth versus value over the last 3 years, it's just a simple interest rate play. So, in that period of COVID where we had lockdowns and interest rates were correlated with lockdowns, you had these big rotations between sectors based on, if we were going into lockdown, then suddenly people were worrying that COVID would never end and interest rates were going down. And that was causing, all of this sort of crappy meme stocks to start to reflate. And then every time we seemed to be coming out or, there was sort of a reflation narrative, then the whole thing flipped the other way. And so it's been this very simple reflection of long-term interest rates just over that 3-year period. And I think that's fine. And, that was sort of predictable with each interest rate move. I think what is not consensus is the idea that something is fundamentally changing between these two types of stocks. And it is related to bond markets, because if you look at bond markets, the bond market doesn't think anything has fundamentally changed. So if you were to see, it became more of a sort of consensus that we were in this secular bear market in bonds, then I think you'd start to see those shifts become a bit clearer, the longer term shifts. But one thing that I think you have to point out is that, we're very much talking about these super cycles and these long term trends. And everything I've said about how to position for this super cycle could be spectacularly wrong over the next 6 months if, we're just in a sort of classic recession scare. It's all going to go the other way. Interest rates go down, terminal interest rates come down, meme stocks make a comeback.
But I almost wonder though if that recession is priced in more than you might guess. Like I could see us having a recession in bonds, the long end not actually going up in price and down in yield.
Possibly. I think it's quite, all you can really do is look at consensus forecasts. And when I look at consensus economic forecasts, people are not really forecasting a recession. They say they are. And, there was this big sell side marketing campaign in December to, publish your 2023 recession forecast. But when you actually looked at the details of those forecasts, everybody was forecasting the mildest recession in history. And
okay, but do you think that that's what they're forecasting and writing down? What do you what you guys say on the sell side is not as important as what your clients are actually doing on the buy side. So when you would go and talk to them, what was your sense about how they were set up?
I think that the consensus has been mild recession everywhere, but a recession so mild that it isn't really a recession. So basically, okay. It was a soft landing. And I think that, if you wanted to sort of rationalize different market pricing at the start of the year, I think you basically had a soft landing priced in, because you had a bond market that was inverted. So you had central banks cutting interest rates, but not to the degree that you'd expect if we were sort of facing a deep and nasty recession. And then you had stock markets that were sort of pricing or earnings expectations that were a little bit pessimistic, but they weren't sort of disastrous. So I think, a mildish, the mild recession that was in those forecasts was sort of not discernibly different from the soft landing that people laughed at when you mentioned it as a possibility. It was all about emphasis.
I get it. One of the thoughts I just had is that you're talking about these fake cycles and how it's been distorted over the last 3 years. At what point does it become a more traditional business cycle? Like, how do we transition? We shouldn't use that word again, but transition from a fake cycle to a regular business cycle.
Well, the easiest way would be a sort of gut-wrenching recession, because it would reset the cycle. If we had a big rise in unemployment, worker power gets killed, wage trends, go down, inflation goes down, and then we sort of reset the clock. That would be the obvious transition, but I just don't think it's going to be that simple.
Well, it's funny you say that, because Jonathan Golub was on Bloomberg getting interviewed, and he said he's the Credit Suisse guy, and he said exactly the same thing. He says the thing that most strategists are hoping for is a quick, sharp recession that resets everything, and then we can, pull out all the old playbooks and go from there. And he says that almost because of that, the fact that everyone wants that, it's probably not going to happen.
Yeah, I think that it's going to be just quite noisy and difficult to discern where the underlying trends are in all of this. I wouldn't rule out a situation where you start to lose jobs in some sectors of the economy. I think that when you look at, if you take my sort of A-shape COVID bubble, if you like, over the last 3 years, and you think, where could that sort of lead to spillovers to the jobs market? Well, you have, some jobs in construction, but, generally, you didn't see a big sort of boom in housing employment, anything related to housing. These companies have all been quite conservative over the last few years, partly because they couldn't get the labour anyway, even if they'd wanted to. Then you have a shift in employment in areas like transport and wholesale, and you could lose some jobs there. But when I look at potential job losses, they just seem pretty modest. It's hard to tell a story where we get a really serious recession. Famous last words, I guess. But I've tried. I've tried, and I think that because the labour shortages are so acute, I think that you could see something that we never get in the US, which is effectively labour hoarding. When I say this to our US economist, he gets a bit angry because labour hoarding is not something that is deemed as sort of acceptable in the US. But because it's more something that happens in Europe. Europe and Japan, we have these recessions all the time, and they're just technical recessions because GDP goes down, but employment doesn't change, because it's very expensive for companies to fire workers and then have to hire them back, because you end up paying long severance pay. So companies will hang on to workers until it becomes absolutely clear that the economy is sort of falling apart and there's no way back. And so the US never usually has that dynamic, but we have these big labour shortages. We have very high levels of margins. So you could get a period where margins actually fall quite a long way before companies feel that they have to sort of start laying people off in a big way. So I think
we might never even get the layoffs. Like it could be almost like a internal recession that never is accompanied with layoffs.
It could be. And also, I think that if you go back to my sort of World War II analogy, there's this big paper that's been all over the financial press over the last few weeks from Giacchetti and those guys. Have you seen this about the...
No, I haven't seen it.
So it's looking at periods of disinflation in the US and a bunch of other countries. And he's argued that since 1950, there has never been a disinflationary period that didn't involve a big rise in unemployment. And he's done it in terms of sacrifice ratio. So how much unemployment you need to get inflation down. And, my point is, yes, since 1950, but the whole point is that this economy much more closely resembles that period after the Second World War, the sort of 1946-47 period. And if you look at that period, we had very, very high levels of vacancies, a very, very tight labour market, and labour demand was destroyed, but it didn't lead to a big rise in unemployment. And this comes down to that sort of path that Jay Powell's been talking about, and Fed researchers have been looking into, where they've argued that because there are so many excess job vacancies, you could actually kill a lot of labour demand, and it would come through job openings and job vacancies rather than a big rise in unemployment. And they say in their paper, there's no historical precedent for this. Well, there is, because I managed to find data on the Beveridge curve, that relationship between job openings and unemployment, back in the late 40s. And that's exactly what happened. Because the labour market was very, very tight, that Beveridge curve was very, very steep. And so we were able to destroy a lot of labour demand without that causing, any rise in unemployment at all. So I actually think there is a scenario where you could have that sort of soft landing in the labour market.
Well, that's fascinating. We got to go and we have to go add some more data. They've cherry picked the data. That's what's going on, Dario.
I put my 1940s Beveridge curve on Twitter, but nobody's ever interested in my 1940s data.
It's right there behind tangible 20s. Okay, you got to tell the story. You called your politicians in the UK morons, or you had a moron indicator of some sort. I do remember it. It got picked up by FT, right?
Yeah, it was.
Can you tell the whole story? Because I think it's great to hear when you rise to fame for something other than gold BMWs.
Well, it's as Lena was saying at the start before we recorded, that she remembers me as the sort of gold BMW man, and the other thing that I don't want to talk about it. And now it's the moron risk premium. I mean, what sort of a career is this? I mean, this is what I'm now known for. So what happens is I take my daughter to gymnastics lessons, and it's really early on a Saturday morning, and every week I try to avoid eye contact with any of the other parents because I don't want to have a discussion about, you know what it's like. And so this one morning I was reading this stuff about what was happening in UK bond markets, and the fact that yields were going up and the currency was going down. And I just wrote this sort of throwaway tweet about that the UK had a moron risk premium, because it wasn't that the policies were massively inflationary; it was that they were moronic. The government had seemed to have lost the plot, and then this thing just sort of blew up, and that tweet sort of went viral, and then the FT picked up on it and started writing about trying to quantify the moron risk premium, which is quite fun. They phoned me up and they said, can you tell us how we might measure this? And I was like, come on, I was joking. This isn't a real thing. And then I had, school friends I hadn't heard from in sort of 20 years sending me messages on Facebook saying, don't you think it's a bit rude to call Liz Truss a moron? And then these guys that I play football with, who have got no link to the financial industry at all, don't read the FT. Just in the last couple of weeks, they've picked up on this, and they've started saying to me, well, why are you calling the government a moron? Are we the inspiration for that? Is it playing football against us that you realise what morons are all about? So, there's a lot of people taking the piss about this. But
that's great. Well, it's good to know that you're known for something other than gold BMWs and the other thing. Okay, so now at the end, we usually ask you some kind of questions that are fun or get to know you. You've been on the show a couple of times, and not only that, you've done such a great job explaining your views that I thought we'd just go with something completely fun. And since I'm a Canadian, you're British, or actually I was going to ask you a question. How do I tell that? What is the difference between British, English, and I know what UK is, but when is someone British and when is someone English?
Well, if you're English, you're just from England. You're British, you can be from Scotland, from Wales, from Ireland. And then UK is just a sort of official name for Britain, I think.
Okay, so you Londoners I can go either one, English or British.
Yeah, I mean, if you call somebody from Scotland, you have to call them Scottish, really, because even if you call them British, they may get upset. But if you call them English, that's going to be deeply offensive.
That's right.
Even worse with the Welsh, they don't want to be known as English at all.
Oh, really? Oh, I didn't realize that. The other day, I tweeted something out about Ronnie Sturfley from Incrementum, the gold fellow, and I mistakenly called him Swiss, and he was not very he's not very happy about this. He's Austrian, and he says the only thing, as long as
if he's writing about gold.
I know, I thought. I thought he's like, as long as you don't call me German. I was like, oh, I'm just going to leave that alone. Okay, so we're going to play a game. And the game is, you're going to tell us if it's English, British, whatever, Canadian, or U.S. Okay, so I'm going to tell you something, and you're going to say whether it was invented or whatever. You'll have to pick one of the three. Okay?
Okay.
So English, Canadian, U.S. All right, let's just
wait. But hang on, if it's pineapple pizza, then forget it.
Well, that's going to be too easy. Everyone talks about that. Everyone knows that one. That one's going to be too easy. I did not include that one. But we'll start with another easy one: the toothbrush. Who invented it?
English.
Yes, you're absolutely correct. I thought that was somewhat ironic, considering what the people are known for.
Are you saying that we have famously bad teeth?
Okay. The paint roller.
It's true.
The paint roller.
The paint roller. Canadian.
Okay, now why did you? Is that just a pure guess?
These are all guesses. I mean, come on.
It was invented in Toronto in 1940. I had no clue about that. I was completely shocked. Chocolate bars.
So it's only it's British, Canadian, or US. That's it.
US. That's correct.
Okay, because I would have gone with Swiss. English, British.
Yes, you are correct. Joseph Fry invented the chocolate bars, but John Cadbury first sold them at the trade in Birmingham. Okay, how about grain elevators?
US.
You're too good. I obviously done a shitty job picking these things. You're absolutely correct. They were invented in 1842 in Buffalo, New York, which is what not what I would have guessed.
I like the way you've put loads of work into this and know all the details, and I'm just guessing. And
how about the donut? And I'm going to make it a little bit harder for you. You got to tell me what year. Pick a year, and we'll see how close you are. The donut.
Canadian, I don't know, 1950s.
So I'm glad you got one wrong, because you were kind of on a streak there. It was 1847, and it's actually Americans. But I will. This brings me to another thing, which is probably why you guessed Canadian. That the number one donut consumer in the world, Canadians.
Canada.
Yeah. 30 million Canadians, roughly. How many donuts do you think we eat annually?
Oh, dear. I don't know. How many donuts do you eat a year, Kevin?
I don't know. I don't know if this is right, but it says 1 billion, and that seems like a lot. That's a lot of zeros. Yeah,
well,
a billion.
I mean, if you have a donut every day, that's quite a lot of donuts.
I guess so. Superman, invented by a Brit, a Canadian, or an American?
American.
No, it was actually invented by a Canadian.
Really?
Okay. Wolverine, in the actual the comic strip, where was James Howlett born? Britain, Canada, or the U.S.?
Britain.
No, it's born in James Howlett was born in northern Alberta, which I was shocked at that Wolverine is Canadian. I had no clue about that. Okay, here's one for you: basketball. Brit, Canadian, American.
American.
No, that was actually Canadian. James Naismith. He was invented in the U.S., but he was actually a Canadian. All right, let's see what else here we have.
These? Did you just say?
I just tried to find the. Here's one. Here's one that's going to be tough. Again, I want a year, and I want potato chips. British, Canadian, or American?
British. Late 1800s. I don't know. 1890s.
George Crumb at Moons Lake House near Saratoga Springs, New York, is going to be upset to hear this, that he invented potato chips in 1853. Let's
I
see. I'm
wasn't
going to get
far
it.
off.
No, you weren't that far off. Okay, here we go. Two-stroke engine. British, American, Canadian.
British.
Oh, you got that one. Do you know who invented it and when?
No.
It's a Scottish engineer, Dugald de Clerk, who patented his design in 1881.
Yeah, it's
All
the
right.
sort of industrial
And then
revolution.
we'll finish with this one, the tape measure.
The tape measure, American.
You're absolutely right. The tape measure was in New Haven, Connecticut resident Alvin J. Fellows, invented in 1868.
So you kept score, and then I guess, at the end of the year, there's going to be a prizes there for the best one.
Well, you've been a real trooper to be on the show, Dario. Can you tell people where they want to learn more about you? I guess your product is actually institutional product, so tell people where they can find you if they're institutions, and then also I believe that you have a Twitter handle that you're quite active on, and I highly encourage everyone that's not an institution to follow you there.
Yeah, so I think this is my third time on the show, so I think I deserve the title of friend of the show now.
Yes, you do. You absolutely do.
Good. So the best place to find me is on Twitter. It's Dario Perkins, all one word. I put a lot. I mean, I don't take Twitter super seriously, but I put a lot of stuff on there, a lot of different.
You do.
I think
people. You actually do. I'm actually shocked at how much good stuff you put on there, to be honest.
The thing is, I get complaints from people that don't know what my view is. I get these messages saying, "What on earth is your view?" And I'm like, I'm not here just to give you a view on anything. I'm here just to exchange ideas and to show you stuff I think is interesting. And often I use Twitter as a sort of research that, if I'm working on something, I'll put something on Twitter and see what people say, and if I'm looking at, if I need to look at a different area. Because there's a lot of sort of collective knowledge there's a lot of nonsense too, but there's a lot of collective wisdom on Twitter. So, I try to be quite open and if there's things that I don't know or I'm, something I'm working on, there's a lot of sort of work in progress stuff on there. But
Dario, sorry, I just didn't mean to interrupt, but I just want to say something. I have about a half a dozen people that I have bookmarks for their Twitter account, and I check it every day. And you are definitely one of them that I check every single day, because I do think that you put a lot of great stuff and some terrific discussions and some other, really smart people engaging with you. And it really is how Twitter should be used. There's not a lot of, there's no nonsense there in terms of just guys arguing about whether the next tick's going to be up or down. These are people that are thinking and talking about ideas. And it's a great example of how Twitter can be used for positive.
Yeah, I mean, I don't have anything to sell on Twitter, so I'm not trying to push a view or sell anything. I'm just trying to, engage and exchange ideas, and I use it as a resource for research. So, it's quite open, and I guess that's sort of my contribution. But it's I don't believe in arguing with people on Twitter. I just don't find that. I see people having these arguments that go on for sort of 3-4 days at a time. Why?
I don't get it either. I'm always confused.
The other thing is, a lot of people on Twitter really seem to hate each other, which I don't get, because I follow a whole range of people. They have very different views. And some of them really seem to hate each other, and I just don't get it. I don't understand it. I don't know why.
And some of them hate each other for their actual views. And I'm always like, great, you like bonds, sold to you. Like, I don't care. Like, I need someone to trade with. So I'm quite happy if you have the other view of mine, right? But these people seem to take it as an offense if you don't agree with them, and it kind of shocks me.
No, it's really I think you're right, and I think there was one show that you did a few months back where I don't know if it was sort of triggered by Twitter, but you were sort of urging people to remember to be kind to each other.
Yes.
And I feel like that all the time when I see these sort of arguments and this nastiness and this toxicity on Twitter. I just think, life is much more than Twitter. it's just not worth it. I don't know why you'd get into these sort of fierce arguments with people on Twitter. It makes no sense to me at all.
Yeah, life is too short to spend time arguing on Twitter. But Dario, it's never too short to have you on the show. It's a pleasure having you. It's always tons of fun. The moron risk premium, I don't know. We're gonna have to when we have you on for the fourth time. Now that you're a friend of the show, we're gonna you'll have to come up with something else. So the bar is raised high for you.
There you go. I'll try to insult somebody and get famous for it.
Thanks.
I think it's fair game, insulting policymakers, actually.
Oh, I completely agree. My rule is, as long as you're punching up, you're always allowed to do it. Exactly. That's how I view it, and I'm more than happy to punch up. I think that the guys punching down are the real problem. But
exactly, and I think one of the things I love about your show is that that you and Patrick, you're both quite humble. You're both quite open. You admit when you don't know things. There's no ego. You clearly get on really well. It's a bit like sort of Top Gear of macro podcasts because it's just two friends sort of discussing.
So who's the asshole? Who's the Jeremy Clarkson?
I don't want to get into that. No, but you know what I mean. It's that sort of that friendship dynamic, and a lot of podcasts don't have that because it's just ego and selling something. And I just think, you do something different.
Well, thank you very much for those kind words. So, Dario, thanks again. We'll see you in another kind of 6 months for an update.
All right.
Thanks for your time.
Take care. Thanks.
All right, Patrick, it's time for Talking Charts. You just, it's such a big week. You feel like there's a lot to talk about. We couldn't miss it.
We couldn't, buddy. Let's quickly go through the top 3 things we were watching last week. We were looking for that Japanese monetary policy statement, and they were more or less in line. Nothing new there. Initially, the yen weakened, but that has changed since. We'll put up a chart on that. We were looking at those ISM numbers as well as the job numbers. And really, while those were important, obviously it was this regional bank thing that really kind of stole the week, didn't it?
Oh, for sure. And it kind of came out of nowhere. Yeah. It's it really towards the end of this week in terms of it really, Patrick, yesterday morning we woke up and SIVB, Silicon Valley Bank, it had gapped lower, but the market was still up. The market, it was rallying and the S&P looked fine. But by lunchtime, it kind of started to drift in and the contagion started spreading, and then it really started to get worse by the afternoon.
We'll talk about it in greater detail here because I want to dive into it here as soon as we get this. So let's talk about the top 3 things to watch for the next 2 weeks. And for me, one of them has to be the dollar index. It prairie dogged, bud. The notorious prairie dog has shown its face. So here, let me quickly show. But it was consolidating.
Oh, it is a good prairie dog.
It basically broke out, looked like it was ready to go, and gave it all back. And I think this is one of the most important things to watch because the dollar influences so many different asset prices and so many correlations. And if this was a fake out and the dollar, for whatever reason, heads for like a double bottom retest and remains somewhat in a weak state for let's say the coming weeks, that could be the fuel that gold and other types of assets all needed for a little bull run. And so determining whether or not this was actually a fake out breakout and whether there's going to be a downswing in the dollar is actually a very key thing to watch for me.
It's a real shock that you've managed to squeeze it in there in the top 3. The only real big surprise is the fact you didn't put it number 1. All right, what do you got for number 2?
Did the bank crisis start a new sell cycle in the markets? I want to talk about the bank crisis, at least this small regional bank crisis, not like the big money center banks are in big trouble or something. But the thing is that did this kind of shake the confidence? And one of the easiest ways to gauge that is simply observing the fact that for the first time we've seen a spike in the volatility index in a long time. And even though the stock market is flat, it's up only 10 points on the day, but the volatility is spiking because everyone's grabbing at that risk premium to hedge out their portfolios and to do whatever they need to do. And that is the first time we've seen this kind of nervousness returning to the market in many months. And I just feel that this might have just broken the psyche of investors. Like in order for that fragile bull to keep going, for us to see 42 and 4,300 on the S&P, it required positive feedback coming back and the market being comfortable and complacent to keep pushing higher. And the question I'm simply asking, did this little SVB Bank situation psychologically throw investors out of loop?
I'm surprised you put that as number 2. What's number 1?
Well, I just maybe I should have had that as number 1. But number 1 is next week we have all the economic data. Just within 24 hours, we're going to get the CPI, PPI, and retail sales. And obviously, that's been attention. Do you think you would have flipped it? Would you have put the economic?
For sure.
Yeah. Okay.
The bank crisis. If this is correct, and this does get worse, and it's the number one thing to watch. It's KRE's never traded that as much as they did yesterday. There's all sorts of regional banks that are down 30-40% this morning, and it's looking ugly.
Let's get into it. I want to talk some charts with you here. So, obviously, the whole talk is about this KRE, and it's down here $50. I know this one guy that wrote an article about it yesterday.
Guy's an idiot. He's talking about buying this thing. What kind of fool would buy this thing when zero hedge and everyone is talking about doom? Don't you know that this is going to be...
You always turn to defend yourself by the fact that everyone has to be zero hedge doom, because if they don't agree with you.
Ends up being that there's a lot of doom out there, and it is interesting. And
is it really doom? The S&P's up 10 points. I mean, is that
No. I'm not. I'm just arguing about what the messages sent on the side of people that are saying this is basically the start of a GFC is what I've read.
Well, okay. I'm not necessarily in that camp. To be honest, the one thing that I've been consistently saying is that this pending, and I do believe we will have a deeper bear market in the coming year or more, but I will not look like the financial crisis. It won't have mortgage, subprime and other issues that are going to be the drivers behind it. But it is interesting because this is a crack in what was the tech funding, and arguably, the funding of all these tech startups and unicorns was the big bubble, the ARK investments of the space. And these financial institutions going down is simply the realization that bubble has burst, and now the collateral damage of that bubble bursting is starting to show through. Do you disagree with that?
No, I 100% agree with you there.
Right?
I think if you're going to extrapolate this to anything, you should extrapolate it to the continued unwinding of that one of the craziest bubbles of our lifetimes, which was the kind of dream tech stock / SPAC / ARK / Tesla.
Yeah.
All of these things, it was a huge bubble. And this is, you're absolutely right, collateral damage from that, and this is just another step along the way. So I'm only pushing back, Patrick, about it spreading to the banking system. And so I'm not going to actually push back on you. Like, I actually agree with you, but that doesn't make it a buying opportunity. And this is where and just to be fair, because you referenced what I wrote, I am buying it versus the S&P. So
which I think is actually, this is where I want to kind of rib you a little bit, because hedging this with the S&P, in a long-short combination, while it's a very traditional hedgy way to put it on, like a question I have for you is, why are you always so shy away from grabbing at some gamma? Like the thing is that it wasn't like this thing literally.
What you mean,
dropped.
like buying calls on this?
Well, or any option strategy. Like I'll give you an example. You turn around. Let's say you bought at 53 yesterday and started to put on a position. You wiped out. You're down $3 on your position. The S&P hasn't hedged out a penny since in the overnight price action.
Agreed. And first of all, I started today, so like I wrote it up late last night, and so I was starting today, so I'm long from today at the open. And
but you have a delta 1 downside risk, and we have no idea whether this thing stops at $45, $43. This thing, but yet you could turn around and put on, let's say, a $5 wide bull call spread 2 weeks out, and put out $1 or $1.50 or something like that on a spread to have a 3-to-1 payoff or better on a spread trade. And if this thing just keeps crashing, you have a very clear defined risk and can certainly even reposition the spread at a more favorable time. Like, I don't understand why it's a great idea to play this long equity. I think that this is the perfect candidate for options trading because there's so many better ways to define the risk-reward proposition.
That could be, and I'm not disagreeing, but I think that a lot of the market is very concerned about the potential of contagion, and that's reflected in the option pricing, and it's reflected in all the pricing. Like it's just a different style. We have a different style. I'm willing to stand in here and say I think that this is not going to be the source of the next crisis. That it's going to come from somewhere else.
What's your time?
So I bought half the position, and I'm either going to buy the next half when it goes lower or when it goes higher in terms of like one of the two. And so I expect to hold this for months, likely.
Yeah. My perspective on this trade is that just due to reflexivity, when just like what we saw when it bounced off of 49 this morning and whipped up to $52 in short order, there's going to be at some point a 10, even 20% reaction the other way. And that's simply because this thing's had its face ripped off and it's going to have a reflexive rally. But I just think that it's going to be months before anyone wants to touch this shit with a 10-foot pole. I think this.
I disagree there.
No,
but Patrick, it's also you hate banks. Like you laughed at me. You laughed at me when I bought European banks. You laughed at me when I bought Japanese banks. You just hate banks. You think it's the center of the crisis all the time.
First of all, I did not make fun of Japanese and European banks. I did make fun of you for the U.S. banks, and I think
you made fun of me for the European banks. I'm going to take the other side of that. First of all, you make fun of me for most things, so it's an easy bet that you made fun of me.
But anyway, the point here is that,
1 second. There's the Kevin with a blue ticket, and it's not to buy options. It's got to be foolish. It's got to be wrong. He's buying first. He's doing it wrong. He's buying first. Don't you know you sell first?
No. Anyway, the point here is that I think that the next time regional banks will be a major buying opportunity will be after they've been bled out at the end of the bear market. And I still am in the camp that we're in a bear market, irrespective of the fact that we're more than 20% off of the lows at one point on the market. And at some stage, there's going to be big money made being in regional banks. But the thing is that these are all banks are these highly leveraged credit machines in a
they're not as highly leveraged as they used to be.
Not as used to be, but they're still. The Fed is tightening conditions, raising the cost of borrowing, which is going to inevitably stress the debt holders. It's going to put default risks much higher. You're holding the idea that these are going to outperform you owning some proper basket of industrials and resource names and other things.
I'm not going to short them against that, but I'll short them against the S&P 500 though, which is like 8 of the big names is the FANG mat.
I'm in the camp that that the next time it's time to buy the financials is going to be after the shit show's all done. And
Hey, listen,
and we haven't seen
it could be. Listen, I'll look like a complete fool if this weekend a couple others fail and we get into a real run. That could be.
But I don't think that even has to happen. I just don't think that this is going to be. Okay, it's we both can agree that when the short-term selling, this kind of steep crash ends, there's going to be a reflexive rally. There's going to be $5 or more on the KRE within days. It's going to have that reflexive snap. And so if you're buying tactically at the right bottom moment, you're going to catch yourself a quick day trade profit on the upside. That I will agree will happen. But after that, I still think this thing's going to be stuck in the mud and in the gutter and some purgatory for the duration of this entire.
But again, I'm doing it against S&P. So why don't you divide it by the SPOOs? Like take that KRE, divide it by SPY.
I still don't like it.
I know you don't, but at this point, and then back out. We had to move higher. Like, can you zoom out? Keep zooming.
But
so we had a move in 2022 where they outperformed, and so to me, this is just a correction.
Look at what it did in 2020. This is what I believe.
Yes,
is
so 100%. So
right
yeah,
here.
I get it. I get it. You brought up 2020 because 2020 was a crisis, and listen, if we end up having a market crisis, I will likely be wrong. Not going to dispute that at all.
Yeah.
Anyway, I know you don't like it. That's what makes the market.
I just think that it's too early. That's all I'm saying. It's too early. Anyway, so listen. The interesting stuff is looking at some of the individual names. Like obviously, the big story has been the SVB Bank, which basically it was just announced that they're shutting it down. Right?
Yeah, it's done.
The FDIC just came in there and basically, deposit insurance. It's the first bank failure of the year, right? So it's going to be really interesting, obviously, how this all plays out. But it's ugly.
And Patrick, I just want to emphasize something here. This was a big bank.
It was the largest holding in the KRE.
Yeah, it's a big bank. It's a big deal. I get it. I'm not disputing that at all.
Yeah.
And I think at the margin, I push back on everyone who tells me that the Fed tries to go and influence stock prices. I always say, no, the Fed doesn't. There's no S&P put. But I definitely believe that there is a bank credit and like a corporate credit put 100%. So I think that the Jay Powell and company perked up and looked at this, and at the margin, this is going to influence their behavior. This is worrisome. I am not trying to say there is nothing to be worried about. This is a big bank that has failed, and it will have effects. I'm just not sure that the effects are what everyone thinks they will be, and because I think that the balance sheets are better than they expect. I do think it's ironic, Patrick, that the asset that everyone is most worried about on all these banks' balance sheets is the asset that the government the regulators force them to own. And it's really funny because the people that seem to be the most bearish on the banks were probably the most bullish on the bonds. So it's kind of a little bit of a dichotomy there.
Yeah,
in essence, they think that they were probably the ones. If we kind of looked at the people who think that this is most likely going to be a contagion, they were probably also the ones saying that you should own bonds. And yet the bonds are what is actually causing all the problems with this bank.
Yeah. The other one that was interesting is Silvergate Capital, which is much more tied up with the crypto space. Correct me if I'm wrong, but it was Mark Cohodes that's been all over this one, right?
Yes, I believe it was Mark, and there's a couple others. Yeah, no, listen, they've been bang on. This is ugly, and Patrick.
I mean, it lost 90% in a month.
I'm actually with you in that you believe that this might be a turning point for the stock market and that we might get selling. I'm much more worried about the general stock market than I am about the regional banks. I'm much more worried about all these tech stocks that have just ripped for the last 3 months, and they're the ones that are actually the problem. So
you know what? But if when I hear you say that, then why the hell would you just not put on the S&P short and not buy the KRE?
Because the reality is I'm also short. You know the crazy tech stocks that I'm short. Maybe you didn't read those, but I read that post because I'm never sure. By the way, one of my pals did say when I was telling him that I feel good about the KRE trade because Patrick's giving me a hard time about it. He says, Patrick actually read it? I'm not sure if he was more surprised that you read it or that you can read, but I'm not. I don't want to speak for him. But the reality is that I am short all these other crappy ones. Like so I don't need to add to my Bitcoin short. I don't need to add to my Tesla short, my ARK short, whatever. I already have that trade on. So in essence, almost I'm looking at it and going, oh, this is actually an opportunity on the KRE. So I listen, I get it. I understand why you don't like the trade, Patrick, but your aversion to it is part of the reason that I think it's actually a good trade.
But then let's look at this. All right. So this is PacWest Bancorp. The thing got killed from $30 down to 13. Right, like just completely murdered. Like FRC, which was that First Republic, another one of those huge banks, from $150 down to like 45 before it started this huge intraday rally. Like it's just amazing, the bloodbath. This is not just one regional. Like they're like literally blowing these banks up.
Yeah, Patrick, I agree. I'm with you. This is worrisome. The Fed will be looking at this. It might even affect the Fed.
Yeah.
And I'm not disagreeing about any of that. I'm just disagreeing about how to trade it based upon that. And I don't think like for those that are thinking KRE goes lower, maybe it does. I'm not disagreeing, but I just think that if I'm going to look a couple months from now and I'm going to be like, this was a time to buy those things. Because ultimately, I don't think that these concerns are as big as the market thinks. And you have to go through it, and it's just, I think
they're going to allow a couple.
Patrick, there's lots of scars from the great financial crisis, lots and lots of scars. But then you go and you listen to Steve Eisman from The Big Short. He's talking about, he's like, no, the banks are actually in good shape. And maybe he's wrong. Maybe all these people that have been sold a bill of goods and that the Fed, all these banks were speculating on the bond market, and there's way more bodies buried there, and it's going to get worse, and it's going to cause a self-reinforcing selling cascade that in essence is the end of this bull market, and it causes the Fed to stop raising rates.
Yeah.
That could be. I'm not saying that there's no way that can happen.
And just to make it clear though, I am not short any financials. So this is not me taking the other side of your trade. Like, I just think that you're way too early to the financial buy. That's all. But you've been early to so many calls, including, you know which one you've been pretty early on? The yield curve steepener. We had a little bet on that, did we not?
Yeah, we did. Now we're taping this before that's settled, but this
am I Gucci'ing the world?
Well, you probably are Gucci'ing it, but not only that, this end of the world with the banks is good for me.
Yeah, it is.
It's been going on for 2 days. Like, what's the number?
Because we're at negative 92 basis points. So and we have by the close 87 basis points, I think, minus 87. So
it could listen. I'm not.
We'll find out. Well, I'm looking good, but there's a chance. Well, we'll settle it. We'll settle it next time. We'll settle it next time. But it was a very distinct reversal in almost all the bonds. The 2-year reversed. The 5-year, they all did. It's a huge turn, and the reality is that if there was ever anything you're bang on, that if there was anything that was going to cause the Fed to kind of pay attention and maybe take their foot off the brake is some of these banks blowing up, and so maybe that actually
100%.
Yeah.
Like I even wrote that, Patrick. I said the Fed wants to put 3 million people out of work. and they wouldn't bat an eye about that. But if all of a sudden the banking system gets into trouble, then they're going to be paying attention.
Yeah.
And you might not like that. It might not be what you think as a society member that it should be, but I think that's how it is.
Yeah.
So I am really bearish though, Patrick, on the other tech things. I think that this very much, you could be onto something when you highlight that this might have been a change in sentiment and that we are going to get another wave of selling in that sector is where I think it comes.
All right, there you go. So I want to just look at one last chart on gold. And all I wanted to highlight was that very nice breakout in gold that is coming literally the same time as the dollar index is breaking down. And I thought the reason I put number 3 on the dollar index, because I think if we seen the U.S. dollar run out of momentum here, and we see some of these cross currencies start to do well, that could be the environment for gold to go. And I'm paying attention. One day does not make a new trend. I don't want to already talk like this is a certainty, but pay attention. If this gains some momentum, maybe this is the push that's going to take it to a fresh 2023 high.
All right. Sounds good.
All right. Anyway, that's where we'll wrap it up for today. I guess we just go to the close here, right, bud?
Yeah, that's right. Okay, so thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow on Twitter. You know the whole 9 yards. Patrick, where can they find you?
You can follow me on Twitter at Patrick Ceresna, and you can find me at bigpicturetrading.com. Kev, where can they find you, bud?
They can go to check me out, my newsletter at themacrotourist.com. And if you're interested, you can go to the Substack. It's free. You can go and get involved in the chat. We have a bunch of people there that are really terrific market folks that are share all sorts of stuff. It's a great environment. Feel free to come in and say hello. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. No after show. We'll see you in a couple of weeks.
Take care, everyone.